Now on to this morning's scheduled programming. This morning's breakfast panel will be discussing a topic that is on everyone's mind these days. So without further ado, it is my honor and pleasure to introduce this morning's moderator, Jasmean Toor. And we're going to bring up Jasmean Toor, who is our Vice President of Real Estate Finance at EDGAR Development, and she also serves as Treasurer on the NAIOP board. So welcome to the stage, Jasmean.
Good morning, everyone. My name is Jasmean Toor, as Paula mentioned, and I'm the Vice President of Real Estate Finance at EDGAR. Thank you for joining us this morning. I'd like to introduce our panelists. You guys want to come up here? First, we have Gagan Lalli, Vice President of Real Estate Finance at CMLS Financial. Next up, we've got Nate Larsen, Senior Director of Mortgage Origination at Canada ICI. David Gilbertson, Regional Director of Commercial Mortgages Vancouver at RBC. And then last but certainly not least, Matthew Middleton, Director of Real Estate Debt at Nicola Wealth. Please welcome our panelists. Okay, so this is the part that's making these guys, I think, the most nervous. So I know Gagan, but I just met the other guys this morning, so I want to get to know everyone on a little bit more of a personal level. I'm passing around this bowl, yes. And so if each of you could pull 2 questions from there, that would be great. While you guys are doing that, I'll just mention that I showed these questions to a couple of my coworkers yesterday, and then one of them told me that these are hinge prompts, and I said, nuh-uh, like that's not where I got these from. But then that did lead me to Google some hinge prompts, so one of them did make it into the bowl. I think it'll be obvious as to which one that is, but anyway, just a couple icebreakers. So Gagan, just because you're beside me, please read your first question out loud. Did you get the tough one? And answer it. And then we'll go down the line and back.
What's your love language?
Oh, yeah, okay. Gagan got it.
My question is, what's your love language? So I'm going to say...
They're on there if you don't know them.
They are on there. I'm going to say quality time, because it's the first one.
Okay. Thanks, Gagan. It's very nice. I think that's most people's. Nate, what's your question?
It says, if you could time travel, which era would you visit? It's a really tough one, but I'm thinking the 60s.
Okay, why?
Free love.
Okay, David, you're up next.
Okay, I got some easy ones here, but what is your all-time favorite movie and why? So I'm comfortable in the room. So anytime Titanic comes on, I'm locked down for like 3 hours. I think I've seen it about 12 times. I don't know why. I just love it. And yeah, I'll expose myself there.
All right, mine is, what is the worst fashion decision you've ever made? There's quite a bit of these. I don't know if I can say one in particular, but I'll say I made the decision where my wife dresses me every day, so stop dressing myself. She picks all my fashion wear.
Okay, gotcha. So you've never done the white socks, black shoes, or anything like that?
Pardon?
You've never done the white socks,
No,
black
I wouldn't
shoes
dare to
kind
do
of
that. I wouldn't go that far.
thing? Okay, gotcha. You can start with your second one.
All right, my second one is, what is your go-to karaoke song? I would say probably Journey, Don't Stop Believing. Can't go wrong with that.
Okay. Classic. Thank you.
Another easy one. If you could eat one food for the rest of your life, what would it be? So my family owns a really old seafood restaurant in Richmond. They're originally from Shanghai, so somebody else can pay for it, but I eat king crab for the rest of my life.
You are getting the easy ones. Okay, Nate?
This one is, which sport would you play professionally if you were an athlete? I think the obvious answer for a lot of people is golf, but I'm going to go with NFL quarterback because of all the glory.
Okay. My last one is, what's the dumbest way you've been injured? And there's a lot of dumb things I've done. I guess when I was a kid, I used to run down my stairs, slide down the banister, and one time I went straight through the front door, which was glass. That's probably the dumbest thing I've done.
Oh my God.
I'm still here.
Did you break anything?
Yeah, a few things, arm and stuff, but that's probably one of my highlighted dumb moments.
Okay. Okay, well, thanks, guys. Thank you for being good sports. And now the real fun begins. In the last year and a half, we've seen a lot of unpredictability and uncertainty. We have the highest interest rates we've seen in over 15 years, escalated construction costs, and previously unchecked inflation that is now slowly being tempered. I'm really short, so I have to move up here. Into early 2022, the Bank of Canada started raising interest rates after keeping them steady for almost 2 years during COVID. The overnight and prime rates have increased 10 times by almost 5% since last March. In the last Bank of Canada announcement, they held rates steady for now, which leads me to my first question. How has this unpredictability of interest rates affected credit decisions and underwriting in the last 18, 12, or even 6 months? Gagan, let's start with you.
Good question. I would say one of the biggest things is the unknown. So obviously the metrics are stretched. With higher interest rates, you have lower debt service, less loan to value, so clients have to put a lot more cash in, and that's one of the biggest things that we've been seeing is, can our clients handle the storm and where is it going? Obviously things have settled now, so I hope they've stabilized, so we're in a much more, at least a bit of a more known environment. But I would say our credit groups, our lenders, our underwritings, they didn't know where to go. Where was it going to end up being? So I would say the unknown made people be cautious. So I think some stability will be helpful in keeping us going forward now.
David, anything to add?
Yeah, we're certainly looking for stability, which we saw a little bit of on October 25th. If I think about 3 to 5 years ago, we were underwriting with test rates plus 200 basis points, 250. We've done away with that, so we're writing to actual today, which is nice. Our only buffer is really DSC, so things are getting a little bit tighter. What I find in times like this, quality of underwriting goes up. So quality is a big word that we use. Quality of tenants, quality of location, quality of operator. We know that there's pressures for labor costs, maintenance costs, repairs, interest rate. Like everything is going up. So there's pressure all the way around. So we're looking definitely for quality. I think economics department this morning said like end of Q2 2024, looking for a little bit of a reprieve. Maybe that means just more stability. I think everybody's looking at, hoping that things will stay where they are. I think we all have to remind ourselves that we're kind of at 40-year averages. Some of us have been through this before, in the late 80s, kind of 10, 12, 13, 14% is, I don't think we'll ever get there again, but it will be nice to see when things get a little bit more stable.
Okay, thank you. Given various regulatory and market changes, combined with being in the highest interest rate environment we've seen in years, how are lenders changing covenant requirements to deal with risk? David, I'm going to start with you on this one.
So I run the commercial mortgage portfolio. I'm not on the term side. AJ DeLille runs the development side for RBC. So our facility is a committed facility. We find a lot of borrowers like having commitment through the term. So unless you're defaulting on the payment or one of our other standard terms and conditions, which there aren't many in the commercial mortgage product, you kind of live in the life of the term of the loan, which is nice. So we're not really changing our underwriting criteria very much. We're just really scrutinizing each tenant. We're scrutinizing tenant tenure. We're looking for operators that can diversify their NOI a little bit. Maybe it's mixed-use retail properties. Maybe they're bolting on something in the parking lots, like a standalone franchise or something to that effect. So we're looking for things like that. And we'll talk a little bit about asset class and where we see caution. But we're not really changing things. We're just scrutinizing everything a little bit more because we're not underwriting with any large test criteria of like plus 200 basis points. So we're really scrutinizing, and quality in underwriting is really coming up, and we'll talk a little bit about the broker market as well.
Okay, Gagan, I'm going to go to you next for this one.
Yeah, I would agree with all that. I think scrutiny is key. I think one thing we are doing a lot more of is not just looking at the property, but the borrower overall and the liquidity, because we are seeing how one asset can bring down the other assets. So I think overall it is a much more global overview. We're looking at borrowers, which before we maybe concentrate on the asset a lot more, which we still have to do, of course, but we are looking at the overall picture much, much more than we ever have before. And with that, we want cash flow and liquidity. And if not, we want to understand the plan of how it's going to get worked out.
How is it differing for construction loans versus term loans?
Well, I think those are two very different animals, of course. So construction liquidity is like paramount to have that, and the execution, because money doesn't solve all problems. So I think we definitely want to make sure our borrowers are much more experienced. in terms of capital availability, those newer developers are having a harder time than the ones that have experience. So separating those two roads. For term debt, I think as David mentioned, it's there's certain metrics you have to meet. So those metrics are just getting pushed down on loan to value, debt service requirements are going up. So yeah, there isn't really a change of rules. It's just, the equation is a bit different. Yeah.
Okay, thank you. Are there any other changing tests or trends that you've seen, for example, on the borrower side, Matthew?
First off, I would say I'm the only borrower on the panel here, so I'm going to try and keep Gagan honest. Yeah, I would say, like, speaking from a borrower perspective, I think right now it's kind of like your foxhole is almost, it's a meter wider and a meter deeper. It's how I kind of describe the current market. I think, ultimately lenders right now, they're trying to do two things. They're trying to underwrite risk, and then you need to price it accordingly. And I think there's really been, to me, there's been two trends, and we kind of just talked on one, which is, uncertainty on terminal rates, and the other one is just, just a lack of transactions in the market right now, right? And I think, on the first one, when it comes to uncertainty on terminal rates, you kind of felt like 6 months ago you'd have certainty, and you thought 3 months ago you'd have certainty, and you're kind of starting to see glimmers today where you're getting a bit of certainty on rates. But I think without that certainty, like what we've seen on the borrower side is like you get lenders underwriting, test rates with a 7 or 8 handle, and that pretty much is going to like put a fork in any pro forma. Let's be honest, right? So I think now that you're getting some glimmers of certainty here, like it kind of feels like there's a bit of a resistance level on longer term bonds. I think you're getting a bit of a different narrative from central banks than you were a month ago. So I feel like once you have that certainty, it's going to open up loan amounts. I think lenders will be more accustomed to underwriting loans based on current rates versus an 8 handle. I think the second thing, a lack of market transactions, I think that goes hand in hand without having certainty on rates. I think, borrowers, owners, like when you don't have clear certainty on your capital stack, it becomes very tough to transact, right? And so, I think in the market, you've seen a pretty big divide between, buyers and sellers and their expectations. And, without comps, it becomes very tough for lenders to underwrite values. Like, what is a cap rate on an office building right now? What is a cap rate on an industrial building if there's no transactions, right? It becomes really tough to underwrite that value. I think, once you have certainty on your capital stack, then you'll have more transactions. Lenders will be more comfortable underwriting value. And I think that as well will open up and result in more accommodative of financing terms. The last thing I would just touch on from a borrower perspective is just like in today's market, I think really like certainty matters and lending relationships matter. That's what we see. 24 months ago, you would go for a financing quote, you'd maybe go to 12 lenders, you'd get 12 quotes, and they'd all be within a pretty tight range. I think today, you go to 20 lenders, maybe you get 6 quotes, and it's a much, much wider range. So I think having lenders that can execute and you have those relationships, to me, like sitting in the borrower seat, that is the most important thing in the current market.
I agree with you on your last point. It's much easier for us to go to our lenders that we've worked with already, existing lenders, versus starting a new relationship at this point in time. So, yeah, I totally get what you're saying. Nate, anything to add to these points?
Yeah, I think all really good points. I think when we talk about debt service being the only constraint, it's a big constraint. When you have interest rates that have gone up as much as they have in such a short period of time, commercial real estate and income-producing properties are only as valuable as the levered return that an investor can get when they go to acquire it. And when we look back at what those same returns would be from the beginning of 2022 to what they are now, it results in at least a 10-15% reduction in price on multifamily, at least a 15 to 20% reduction on most commercial assets. So that price correction hasn't been seen in the market. That's why we don't have the transaction volume anymore. And there are a lot of loans that are underwater. A lot of right sizing needs to happen right now. There's a lot of extend and pretend with existing lenders if the relationship is there, but oftentimes that requires a lot of right sizing, big payments on principal balances. And we're seeing a lot of mezzanine lenders being a lot tougher on things like extensions, especially on land. They're very expensive and a lot tougher on what those extensions look like. And I think things like subordination and standstill agreement, if you've got a second mortgage lender and they're willing to give a nice standstill for a first mortgage lender previously, now they're saying, maybe not. I'd like you to pay up if you want to do a refinance. Things like interest reserves, they're going to be really sticky on, and things like interest rate buy-down reserves, lenders are going to be really sticky on as well. So we're seeing those trends. The transactions are happening, but it's tougher out there.
Back to Matthew for a moment. For those of us who don't have any assets or funds in the U.S., how does a lender's underwriting and criteria differ in the U.S. versus Canada?
Yeah, I would say it's a similar methodology in terms of how you size a loan. I think it's, albeit it's more conservative loan metrics, like first blush, like instead of a 125 DSCR, you're probably 150. Instead of a 65% loan to cost, you're probably 50% loan to cost. To me, though, like the big difference is one, like the loans are non-recourse primarily, and so, really when a lender's underwriting that loan, their only form of collateral is the property, and their only form of repayment is the property. There's little value to sponsorship, and that's just a reality of that market down there. So I think when you have lenders, underwriting properties, like they're uber focused on the cash flow, and like David was mentioning before, like it's tenant rent roll, it's CapEx requirements, it's TI requirements, it's LC requirements. Like ultimately what the lender cares about is what's the true net cash flow of the property, and if I had to take over the property, if I get handed the keys, what's my debt yield? What's my cap rate coming in based on my loan basis, right? And so I think it's just a different approach. I kind of feel like, to be honest, and quite frankly, I think it's the right approach, and I think it's probably something where I could see in the future Canada's probably going to migrate to. The one thing I would say, like that market, like especially, call it March of this year, I don't want to call it a crisis, but let's just call it the regional banking drama you had. Like that was a fundamental shift in the market, and so we were actually down in Phoenix. It would have been early February. We were down in Phoenix touring our portfolio down there, which is primarily industrial properties, and we actually met with a couple of regional banks that we deal with in that market. And it was funny at the time, like we literally left all these meetings and spent an hour and a half talking to these lenders, and at the end of the meeting we all looked at each other and said, like, we just talked about bank deposits for an hour and a half. Like we didn't even talk about our projects, we just talked about bank deposits for an hour and a half, right? And this was in early February, and then a month later you had obviously SVB go down, I think it was Signature Bank, First Republic. At the time, we didn't think anything of it, right? But what happened in early March really fundamentally changed the market. And so, when we actually were going out for debt terms, this would have been like April, May, June, you would go to essentially any regional bank, any almost US lender, and for any type of development financing, in order to actually procure that financing, you needed to provide deposits anywhere from 10 to 20% of the loan amount. So if you're procuring debt for $10 million, you literally needed to give the lender $1 million to $2 million of cash as a pre-funding condition to get that loan. And so you think about it, like the best of times in the US, you're probably getting, maybe 60, 65% loan of cost on a construction project. With higher rates, it was probably, 50%. You tack on a 10 to 20% deposit, like your effective leverage is 40%. Like, I think we can all agree to pummel 60% of equity into a project with a higher rate environment, it becomes really challenging for that to pencil out. And so that was a fundamental shift in the market down there earlier this year.
Okay, thank you so much for those insights. As most of us in this room have seen, all these changes in covenant requirements, underwriting, and credit decisions that we've just spoken about have led to some significant financing challenges. On that note, let's talk about everyone's favorite asset class to finance right now, which is office. What are the hard truths I need to know about getting debt on an office building? David, since you're doing term and IPP, why don't you start with that one?
Sure. So obviously a class that we've been tracking for the last couple of years. I think in Vancouver we really enjoy probably one of the best markets in North America, probably 11, 12% vacancy. In Toronto, we saw a lot of square footage brought on in the Class A space and broadly across North America. And I think what happened was a lot of Class C and Class B tenants kind of moved up into Class A. Class A is pretty full. Class C and Class B are sitting around. We're seeing a lot of stuff on the affordable side, looking at conversions. Conversions are tough, really, really tough. We haven't seen a lot of really big office conversion lately into potentially residential. I was out in Halifax for 5 years, about 6 years ago. Purdy's Wharf is a great example of two gorgeous buildings that sit over the water that are quite vacant, and it would be almost impossible to convert them at any kind of return into residential. So that's a challenge. We, on our book, we've never we've partnered with syndicate clubbed larger office deals, but obviously looking at tenure of the tenants is really critical. We've also seen, a lot of clients, in, probably us eventually, looking at consolidating spaces, and we don't know what that looks like yet. We've seen national tenants, international tenants moving from 110,000, 150,000 Class C into 50,000 of Class A, which is great for Class A, but not very good for the Class C and Class B type stuff. So I would say certainly very challenging on the large core urban asset side, and that is morphed into suburban. And anytime we get a project that has kind of mixed use, so we've got some retail on the bottom or something different to diversify, the NOI much better. So back to a comment that you made, Gagan, like understanding the strategy of the portfolio of the client that we're dealing with, and their effective management within that particular asset is critically important to us being able to participate with them.
On those buildings that you mentioned in Halifax, does the incumbent lender stay on then, or how does that get financed?
We're not, I would say I'm not sure how they ultimately get financed. We leave a lot of it to the pension funds and whatnot to come in, the insurance, the life cos. We don't do a lot of participation in those very large assets. So.
Okay, thanks, David. Nate, do you have anything to add on how office financing is going these days?
Yeah, so Vancouver is a very special office market. The rest of Canada, especially in markets like Alberta that have had some real problems in the asset class, you're probably looking at your weighted average lease term times 2 as your maximum amortization. Whereas here in Vancouver, it's probably achievable to do 20 to 25 year amortization. As how that relates to valuation, I think with interest rates as high as they are right now, you're still probably going to be somewhere around or below 65% LTV. However that's dictated. I think a lot of lenders will take what they anticipate. Even if your best interest rate you could possibly find right now is 5.5%, there's still probably a point premium added as a cap rate as a buffer there. Industrial and multifamily assets can be valued with cap rates that are below borrowing costs still, because there are structural supply shortages, whereas office supply continues to come online. That being said, AAA and A office in Vancouver is performing extremely well and will continue to do so. And there will be appetite from non-bank and alternative lenders.
Okay, thanks. We're going to shift gears a little bit here. So many developers have experienced challenges, as we know, with multifamily rental construction financing in the last year. Given the fluctuations we've seen in rates and even policies, what are the biggest challenges right now with CMHC financing, and I'm specifically referring to the MLI Select program, as it still seems to be the flavor of the day over RCFI. Nate, we're going to start with you.
Sure, yeah. So CMHC is a lifeblood of our industry on the financing side, and our volumes have been extremely strong doing CMHC financing, the bulk of that being MLI Select. So the financing of it is not necessarily what make these projects difficult. I think for Vancouver specifically, it's the viability of the project overall, given the extremely high land costs and the extremely high construction costs and the long holding period through the development cycle that you have to hold land for to get through in Vancouver. In other markets, you're dealing with CMHC fighting you on a super high vacancy rate in markets that they don't want to do any more projects in. That's not the case in Vancouver. CMHC is very, very supportive of getting applications through. I think it's actually just the viability of the project itself for this market. So until there's more distress and duress in the land market where developers can acquire land for a price that makes a rental project work, or if there's multi-level incentivization for projects beyond just what CMHC can provide as an insurance product, it's probably going to remain challenging to build rental in this market.
Okay, thanks. Matthew, how about on the borrower side? How are you finding it?
I was hoping you weren't going to ask me this question. This is a loaded question. I got to think if I have any applications in the queue here. I think the two, this is coming from like a borrower perspective here, like the biggest challenges are time. Like, I think everyone knows it's like a 6-month wait to be in the CMHC queue right now. So from a borrower perspective, an owner perspective, like that's a long time to wait, right? And plan the capital for your various projects. Now, it seems like it's picking up, which is good. So hopefully that improves, because it is tough to manage that time frame. I would say the second thing, it really comes down to like rate and rents, right? And rates you can't control. Let's be honest, they're like a yo-yo right now, right? And so it really comes down to like market rents. And I think if you're looking at markets like Vancouver and Toronto, you've got significant rent growth. And so are you truly getting current market rents? Is it rents from 6 months ago, or is it rents from today? And so I think having a bit more transparency on how they're underwriting rents would help, right? And I think it's really in markets like Vancouver, it's so constrained. You've got this rent growth, and metrics are already tough. So if you're underwriting on rents 6 months ago, it's vastly different than today. I would say the last thing about CMHC, and I'll be delicate how I put this, is just to be honest, I have a hard time understanding why you have underwriters in different parts of the country underwriting deals in other parts of the country. And there's nothing wrong with an underwriter in Vancouver underwriting an asset in Halifax. There's nothing wrong with that. But should that individual be underwriting assets in Vancouver, Calgary, Toronto, Montreal, Halifax? To me, I don't understand that. I think you should have underwriters focus on either provinces or select markets, so then they become experts in that market. And I think, to me, if I'm looking at this objectively, if I'm an underwriter and I'm just doing deals in Vancouver, Kelowna, Victoria, I should know those markets at the back of my hand. I know the different submarkets. I know the rental comps. I know the players in those markets. But then to have that person now underwrite a deal in Halifax, that's really challenging, right? And so to me, it's like, listen, if you just focus on that market, you're going to make better decisions. You're going to make better risk decisions, and you're going to make them quicker. And I think that would alleviate the time frame. So if I had to, pick one thing that I would tweak, to me, that's what I would do.
Yeah, thank you for that. I know what you mean in terms of the underwriters, in different locations, and it really does depend on their underwriting. So there is that sort of you're not going to get consistency, unfortunately, and that's hopefully something that CMHC is going to work on. But
I think it's just you desire consistency. Let's just have a consistent platform. You always hear different groups in Vancouver submitting their applications at the same time, but yet one group gets a different underwriting rate and one group gets different rents, and they're almost the same product, right? And so it makes you think are they using consistent data, right?
Yeah.
Hopefully that doesn't nix my applications in the queue.
Write a letter to your MP.
Anybody from CMHC in the room? You're safe.
Okay, Gagan, what are the challenges? What are other challenges that you're seeing with CMHC financing in addition to what these guys have touched on?
Yeah, so timing is definitely an issue. You're right. It's 6 months. We have applications we submitted in June that still have been picked up. So that's definitely causing some pain for clients with just, when are they going to start planning their capital and what have you. I think for all the negatives CMHC has, there's a lot of positive things that came out of it. This select program that launched last year has, quite frankly, saved a lot of people's bacon. It has made projects work that would have otherwise not worked. 50-year amortizations is one way to offset interest rates, which no conventional lender will do, but with the government backing, it will get done. So, there's a lot of things that CMHC could do better, but I think this new program they put in was one of the best programs they've ever done. There's a select program, which I think, at least for Nate and myself, we were talking earlier, is probably the vast majority of the business we do. Probably 70-80% of the stuff we do is MLS Select, new construction mostly. There's also the RCFI program that CMHC launched many years ago. So CMHC is trying to do their job. It's not perfect yet. So I want to give them some props on that. But I think wait times are challenging. I think rent recognition is another huge challenge. And what interest rate do you use, right? So we're using interest rates that are applicable today when we're in a downward market, when we know the rates should hopefully be lower at the time. Problem is, it's a double-edged sword. We have loans that we underwrote at 2.5%, 3%, which are now underwater. Our clients can't refinance out of them. So we have to go and refinance, or they have to get cash called. Luckily, rental rates have helped alleviate that, but we are seeing some of our clients have issues because they now have to term out a loan that they no longer can qualify for. So that 50-year amortization, the rising rates, those all help. Sometimes cures the issue, but sometimes they got to find a way to write the check at the end of the day too. So.
See, I think that's a good point, though. I think that's kind of like, to me, like the elephant in the room is like you've got all these MLI select loans are going to be coming to completion over the next 12, 18, 24 months. You know, if that's underrated at a 2.5% rate, today prevailing rates are probably like 4.5%. You know, your DSCR, if you haven't gotten the rent appreciation, what do you do? Because your DSCR is like 110. How do you put mezz on that? And you got to cut a check. So I think a market like Vancouver, Toronto, you're okay because you've gotten that rent growth since loan origination. But in markets where you haven't had it, I think, you know, there's going to be interesting conversations between lenders and borrowers and saying, hey, like you got to cut a check for, you know, a big amount here. You can't put mezz financing on. There's no surplus mortgageability. What happens, right? How lenient are lenders to allow that to play out, right?
Is CMHC saying no to second mortgages right now completely? I know they were looking at them before.
I think that's in the lender's discretion, but you know, there's limitations to everything where a lender's comfortable too. So I think it's case by case what will happen.
And just one more question for any of you. How do you guys deal with the changing policies? I know CMHC can change policies a bit on the fly. How do you deal with that?
Yeah, CMHC is under a tremendous amount of political pressure and so much pressure from all the volume that they're seeing from our industry. So they are trying to make policies to decrease the amount of files that they're having to look at and also to appease the very, very real political pressures that are on them. So there's constant change of policy. An analogy I use, it's like a big cruise ship that's trying to move around like a Sea-Doo, and it's not very efficient, and a lot of the communication comes out and it's often very confusing. So what we do is we just have all of our feedback that's coming in through our different offices all channeled in through one platform that we're able to dissect information through. But there's no question, it's absolutely mind-boggling how they can turn on a dime and change things so quickly on people. So I think having as much feedback from the source where you're getting your information and getting your applications through is important.
Okay, thanks, Nate. So further to some of the points brought up earlier on, and candidly speaking, in this current environment, it can be challenging to get access to money when developers and investors need it. How has capital availability been impacted in the current climate? Let's start with Matt. Started calling you Matt.
Yeah, I think if you're a borrower with, you know, a deep roster of lenders you deal with and diversified lenders, then you've kind of weathered the storm. I think, like I was talking about earlier, I think relationships matter, execution matters. So, like what I see is like you need to canvas a much wider net today than you ever had to, and you've got to deal with. It's not just dealing with 10 lenders; it's dealing with 10 different lenders. Like you've got to be able to deal with like Sched 1 banks, credit unions, life cos, you know, debt funds, pension funds, mix, right? Because they all have, it's all different sources of capital. So you need to have that diversified roster. And so if you have that, then you've probably weathered the storm, right? I think it really comes down to, you know, the asset class you're talking about. I think office, you know, quite frankly, whenever you talk to, and this is maybe a little more US-centric, when you talk to a lender about office, it's a 4-letter word followed by a 2-letter word, unfortunately, right? But I think you've got to talk about, like, office gets painted with this like broad brush, right? Like, what is office? Are we talking about Class B office that's not amenitized, where, you know, a group hasn't put the capital in, or are we talking about Class A that's amenitized, or are we talking about, you know, flex office industrial? Because they're all different. So it's like let's have a thoughtful conversation when we talk about office of like what specific type of office are we talking about. It's going off on a tangent there. Just bringing it back. I think the silver lining is like I think there's a lot of capital on the sidelines. I think there's a lot of dry powder. I think, you know, looking at Nicola Wealth, looking at our enterprise, like I can attest, like there's a ton of investor demand for private assets. Like investors want to put money into private debt. They want to put money into private mortgages because I think if you look at it right now, there's a compelling investment opportunity. Like in the last 15 years, when have you been able to get equity-like returns with a debt instrument? You haven't, because rates have been zero. And so because you have these attractive returns, I think there's a lot of dry powder in the background. I think it's just office is the one segment where it's going to be tough to get capital, but it depends on your product. But I think if you're looking to place capital and you're not putting an office, then where else are you putting it? Right? Multifamily rental is dominated by CMHC. It's ultra competitive. Industrial, everyone wants to do it. It's ultra competitive, so it pushes down spreads. So then if you want to allocate capital, where do you put it? Well, I think it goes into retail. I think it goes into self-storage. I think it goes into seniors. And I think it goes into certain types of office products. So I think the silver lining, to me, there's capital there. And then I think, lenders want to place that capital, right, given the attractive returns in the market.
Thanks, Matt. Gagan, you want to add to this?
Yeah, I'll talk about the capital availability from more the lender debt side. So we're definitely seeing ourselves and lenders being a lot more selective on what they're doing. So we're seeing the risk profile for, as Matt mentioned, the credit unions, the B lenders, the mix. We're seeing them getting better quality credit than they would have otherwise gotten before. So that scrutiny across the board is, where it is very important to have your lender relationships and a diversified lender relationship. Through the last few years, one thing that we've really learned from our clients when we're acting as a broker is if they've always done with one bank, if that bank's turned off the taps, they're hooped, right? And banks can do that not because of the client, but because of their own reasons. So I think diversification of having that capital availability is key. I think at the same time, as Matt mentioned at CMLS, we represent capital for other institutions and various parties. We have seen a big inflow of people that are looking to put that money out because of those returns. Sometimes it meets the threshold, sometimes it doesn't, but these are also funds, institutional groups that would take a bit more risk and yield. I think the banks have that market pretty well cornered on that spread, other than a few institutional funds. In my view, the money's being much more selective, pushing credit quality concentrate that a lot more, but I think it's spurring new investments. It's spurring kind of what second-tier lenders, the B lenders, they're actually growing their portfolios quite a bit. That's what I'm seeing, at least.
Moving over to you, David, do you think there will be more capital available next year, or do you think there'll be more of a crunch in 2024?
Yeah, I definitely think there'll be more in the latter half of the year. I think, speaking on everybody's point here about a diversified lender base, whether I'd like to believe it or not, I'd like to believe that all my clients only deal with me and RBC, right? But that's just not the way it works. And I think preempting one of the questions that you're probably going to ask is, and I see some people in the room like Joey Ty from Crete, I saw him wandering around. So having a good stock of lenders that you can go out to, and having suppliers like the broker market, which has been part of our ecosystems now for a very long time, is really critical. And you need to have them representing you well. I mean, we still have deals that come in a one-liner email that says, this is the property, how much can you finance? And we just go pass. Because that's just not the way it works. Like we need a good quality SIM, we need good quality information, we need strategic information on the direction of the company, the portfolio, the leverage, the recourse position, which to your point earlier, there's probably only 10% or less deals in the income producing side that I can see across Canada that get done with no recourse. That's just the name of our game here in Canada. So, having those partners in your back pocket when you need it is going to be an effective diversification strategy for most borrowers over the next couple of years. And I would say last 6 months we have seen exit from certain lenders, and we do see a little bit of the drying of liquidity. Rates are still ultra competitive. I see pressure on rate for the next 6 months, maybe moving up a little bit. There are going to be lenders looking for a little bit more appropriate return on the risk that they're taking, or maybe being able to stretch and be flexible for existing clients. Again, looking for a little bit more yield and return ourselves. So, yeah, it's going to be an interesting 2024.
Nate, what are your thoughts on 2024 with respect to capital availability?
Before I get into that, I just want to, on behalf of Gagan, myself, and every mortgage broker in the room, thank David for the recommendation that you align yourself with a good mortgage broker.
$20.
On capital availability, I think...
It was the pens, right? The gifts.
On capital availability, I think Matt's point on the ability to get a debt yield that resembles an equity yield south of the border is going to attract a lot of flight to those opportunities. And I think there's going to be some liquidity challenges in Canada next year, especially if you're out there trying to raise equity. That being said, I think there's no end in sight for CMHC insured financing, and I think there's going to be more players entering the market, not less. And I think there will be good capital supply for conventional lending here as well, but I think on the equity side it's going to be pretty challenging.
Okay, thank you guys for your predictions on that. So in recent conversations that I've had with others in the room, phrases like VTB are coming up a bit more often. How are your clients modifying their approach on transactions? David, let's start with you.
Yeah, we're not really sure just yet. I would say that there has been a reluctance to take on properties with very large VTB with terms and conditions, repayment schedules, and things of that nature. We tend to take our own second collateral charges or conventional charges on our own properties, and we like that the best. We tend not to participate too much as a second collateral or a second provider on a first for someone else. That may change. I see those pressures coming to us in terms of being more flexible and then dealing with assets that are a little bit more challenged or struggling, looking at what it looks like over the next 2 or 3 years to help them out. Providing that flexibility is going to be something that's on our plate for sure to look at. But we're hearing it, right? It's the same as moving the deposit on a pre-sale from 10% to 5%. Like there are going to be things that are coming into the market to get it moving that we're going to need to pay attention to and support. So, yeah.
Gagan, do you have anything to add to this?
I think one of the things we're seeing a lot of our clients do is finding deals with existing low-rate debt. We're seeing the deals that have assumable debt to be what is highly sought after. And we'll get the same phone call from multiple clients. Look at the same property because it's got attractive debt on it already. Because that will, essentially push the price up a bit because it is an asset. But we're seeing that as one major strategy is taking over debt. Another strategy we're seeing on the multifamily side is when our clients are going out to market, they want us to go get CMHC approval beforehand, before they actually hit the street, so they can have that in hand for the potential purchaser. So they're kind of thinking ahead. So these are kind of the strategies some of our clients are doing just to help, get more, sales momentum. So those are the two unique things.
That would really drag out the transaction timeline then, right? Because it's 6 months waiting period.
Not a lot of clients can close with cash. So by having that in the queue, you can fund the loan, then the new client can come and assume it afterwards. That's actually been, multiple clients are doing that strategy, and it's been actually working in their favor.
Do any of you guys, other guys, Matt or Nate, have anything to add?
I would say with VTBs, you got to ask why is that individual, why is that seller selling the property, right? If you're trying to sell it for liquidity, then offering a VTB doesn't do anything for you, right? So it depends why you're selling the property. But I totally agree with Gagan. I think if you look at particularly south of the border, if you look at transactions that are happening, it's because there's attractive debt attached to it, and the buyer's able to assume it, right? So, if you can assume debt with a 3 or 4% coupon, that's 300 basis points below prevailing rates. That's a really attractive asset, and if you just mark to market that mortgage, there's millions of dollars of value there. Not that we do that, we don't, but I know some groups do. And so there's value there. So I think that's where we're seeing transactions get done. It's when you have debt that's assumable, and it's well below market rates, right? Especially if you've got I think if you have debt that's assumable, it's got 2 to 3 years of term. It can almost kind of bridge you if you think rates are going to be lower at that time, right? But you need to have that tenor on there.
It's nice to have the certainty of the lower rate right now versus taking the risk on what the rate is these days. This question was a plant by Paul Tilbury, so thank you. Okay, David, you can be honest here, so don't worry about Gagan and Nate, but what advice do you wish brokers were giving their clients right now?
Sorry, could you just repeat?
What advice do you wish mortgage brokers were giving their clients right now?
So there's good and bad with everything. I mean, I think right now we talked about it at the top of the hour in terms of quality. So there are a lot of great brokers out there that are producing great information that we leverage. A lot of them come out of the finance community. A lot of them are great ex-bankers that are now doing the broker side of the business. And so I wouldn't say do things differently. Just we're in a time of underwriting quality, and we need as much information up front as humanly possible. The more information that we have, the faster we can move. If we have all the information, we can close a deal in 4 weeks. Our average deal probably closes in 2 months, 3 months, because it lacks information, including things like environmental reports that we're going to ask for right up front. So to the broker community, the more information that we have, the better it is. And we realize, again, part of the ecosystem, we rely on a lot of this information to move things very quickly. So speed right now is really important for a lot of reasons, but I would just say quality of information and more of it.
Okay, thank you. Nate, on the flip side, what's the best advice you have for your clients right now?
Really stress test your renewals. Anything coming up in the next couple of years. Hope is not a strategy, so really take a look at your portfolios and understand what those renewals look like, and be conservative with that, and start making some plans. The second would be, build a margin of safety wherever you can amongst your portfolio. If that means selling some assets, or if that means doing some different alternative financing on some things to build some liquidity up, like just try to build, at minimum, try to build a margin of safety. And if you're in the position to do so, build a war chest by paying down debt for the next cycle.
Gagan, do you have anything to add to that?
I agree with those 2 points. The other thing that we kind of consult with our clients on is kind of going an eyes wide open. We'll kind of challenge them on what they're suggesting. Not to say we don't want them to do the transaction, but we want them to go an eyes wide open. So we'll play devil's advocate, look at the downside, because I think over many years, every pro forma was just positive and going up and up and up, and you couldn't lose money. I think now we are definitely making sure our clients look at the downside more, have the liquidity for it, and maybe don't do 3 projects, maybe do 2. Maybe tell them to take the foot off the gas a bit. So that's the stuff we're telling our clients, because we don't want them to get burned. We'd rather them survive for another day. Yeah.
Good advice. Nate, this one I'm going to throw to you. What's one thing that makes you worry? So, for example, if the Bank of Canada does another raise in December, what does that do for your confidence?
Yeah, well, I think where we're at right now, the likelihood of more rate hikes is quite low. What worries me is just volatility, because it's impossible for people in Matthew's shoes to move ahead with their projects if things are still in a state of flux. It makes it really difficult to transact. And that's kind of the shell shock that I have since February 2022 of just so many changes happening, having to re-underwrite deals and start from scratch on things. So I don't want any more volatility. I would love to see, 2-3 quarters of consecutive 5 and 10-year bond yields range bound by 30 basis points. That would be lovely. But what worries me the most is that we're going to continue to see all this crazy amount of movement that makes it really difficult to get deals done and for our clients to transact.
Yeah, continued volatility and uncertainty is not going to help the investor side. Gagan, so I'd like to end on an optimistic note. When you think about the economy, what are 2 or 3 things that will tell you it'll be okay?
Non-economist. I think stability is key. That way people can plan. I think picking up transactions again, so we can value things and know what they are, because that will mean everybody, not just the bankers, but the institutions, the buyers, the sellers, everyone's kind of come to a consensus of what things should be. And I think, those are the 2 big things that jump out to me, at least from a real estate perspective. That will show us that we're kind of at a place where everyone's happy to do business again.
And world peace.
Okay. I was going to go to you next, Nate. What was it? World peace?
And world peace.
Okay, well, thank you. Well, we're going to end on that note. That's all the time we have for today. I'd like to thank our panelists for sharing their morning and insights with us.
Thank you very much, Jasmean, for wonderful moderation of that panel, very insightful discussion, and a huge thank you to Gagan, Nate, David, and Matthew for partaking in our first debt panel. So that was fantastic. As always, we would like to thank this morning's featured sponsors. At the platinum level, we have Cedar Coast, Conwest Developments Limited, Cushman & Wakefield, Low Tide Properties, Manulife Investment Management, and PCI Developments. At the gold level, we have Bentall Green Oak, Dayhu Investments Limited, Farrell Estates Limited, Orion Construction, Triovest Realty Advisors, Warrington PCI Management. At the patron level, we have CDC Construction Limited, Clark Wilson LLP, Downtown Surrey Business Improvement Association, Lee and Associates, Remax Commercial, and Wales McClellan Construction. So before we close out this morning's breakfast, I want to say it's been an absolute honor to serve as this year's president of NAIOP Vancouver, and this is my final breakfast of the year. And I would like to bring up Ted Milden, who is going to be our 2024 NAIOP president, to say the final closing remarks.
Thank you, Paula. I'll be quite quick, as I'm sure everyone wants to get about their day, but 3 quick things. First, thanks to everyone for coming today. Thanks to the executive that I've gotten to work with this year, Paul and Paula, our friends at Malachite, and the entire board for all the work you've put in. Secondly, if you're in the crowd today, it's your first NAIOP event, or you're just looking to get more involved, if you want to grow a developing leader, become a company that helps your education, or gets on side with some really important governance work, we are the organization to help you do that in commercial real estate. We really would like to welcome you in a bigger way, so please reach out to anybody. And thirdly, I'm incredibly excited for next year. We've had some great strides this year. Our breakfasts are extremely well attended. We're averaging over 200 people per event. Our social events are all sold out, and our governance is making some incredible strides. So thank everybody in the room for their involvement so far, and I'm really looking forward to next year. I think that's it. Perfect. You're let go. Thank you very much.